You must be pleased with this performance from your new Spac. Tell us just the details of the Spac. 200 million shares, $20 a pop, plus a fraction of a warrant to be executed if wanted at, what, $23?
Actually, the story is this is a company that has $5 billion of capital that's now listed on the New York Stock Exchange, and we've designed the most investor-friendly structure in the history of SPACs without any form of compensation for the people doing the work, which really aligns our interests with our shareholders. And really happy with the reception we got during the roadshow process, and we put together, I think, one of the greatest collections of investors in the world to partner with us in what we're trying to do, which is to buy a minority interest in a very high quality growth company that we're going to take public in an IPO. There's some other bells and whistles and things we've done to design a structure that is both investor friendly to shareholders, but also merger friendly to our potential partner. And that, I think, will enable us to make a deal that's good for both parties.
Right. So you're referring there to the fee structure. You've capped the fee structure. You've also given up, the sponsor fee. It's a little more like some of the SPAC type vehicles that you see in Europe as opposed to here. Talk to us about how the banks gave up those fees and why you also gave up your fee.
Sure. So we're doing this because, we think we can create a one-of-a-kind investment opportunity. What's interesting today is we have the largest number of high-quality growth companies that are private, I would say, in the history of the world, but in excess of a $10 billion market cap. That's due to really the growth of private equity. That's growth of venture capital, late-stage growth equity. That's due to the SoftBank Vision Fund. That's due to large amounts of capital that were available privately. What's happened is COVID is really obviously a very big disruptive event for the economy and for markets. And precisely at a time when businesses need to raise equity capital, it's become a much more treacherous road in which to go public. And the going public process itself is always a treacherous, risky process. It takes many months, and you don't know that you're done until the very end. Meanwhile, you've exposed your company to enormous scrutiny in the intervening period. So the basic idea of a SPAC, raising a cash shell to kind of disintermediate the traditional IPO process, get a lead investor to go search for a great business, negotiate a deal, tee it up for your shareholders, and give them an option in or an option out. I think that idea is a great one. But there have been some troublesome aspects of the structure in terms of the alignment, largely driven by, you could say greed, or just the market would bear a enormous compensation expense. We didn't need the compensation. We just wanted the opportunity to make a great investment alongside our investors and new partners. And we actually went on the road, and our goal was to, if you will, curate a list of some of the great investors of the world that would appear on the shareholder registry. And when we sat down with a super talented CEO who's built an amazing business, they would say, wow, this is a terrific group of people that I'm going to partner with in my first experience going public. And I think that proposition really resonated with investors. With respect to the underwriters, we've had a great experience here with a broad base of underwriters but we've thought about the incentives of all the various participants. We took advantage of economies of scale. And what I mean by that is, while the overall fees at $91 million are large, we pay with the purchase of a warrant, $65 million, go to pay, up a big chunk of those underwriting fees. And the balance spread over a large transaction are in the basis points. So we've designed the most friction-free structure in which to go public. And that, we think, is going to give us an opportunity to buy great business. And
in fact, while they sound large, you've actually managed to cap it at something like between 2% and 3% of the overall. So fees are really, really low in comparison to previous types of SPACs that have gone public in the United States. You're also, though, I should mention, championing minority-owned firms here. And we have a list of the 7 that you're giving, $18 million to split among them, plus real shares?
Sure. So, what's interesting is a lot of people have said, Bill, a terrific, great thing to do, bringing in a bunch of minority firms. And there are other companies that have gone public that are minority owned or women owned, veteran owned, have them in the underwriter group. But one, they've gotten, de minimis economics, typically 1% to 3%. And when I talk to a friend who's a very experienced investor and, banker about this, he says, well, they generally don't do very much. And there's truth to that, but the reason why is that they're not given the opportunity to. And typically, the sort of minority-owned firms are invited in at the last minute. They're put on the cover of the deal. They get really no shares to allocate to their clients, and they get a fee. And it's a win. It's a lose-lose. And what we did is we said, look, these firms are going to add real value. This is not philanthropy. We're going to bring them in early. They're going to be part of the entire process. They're going to introduce us to a much broader base of investors, and they're going to more than earn their fees. And that's been precisely our experience. We have real diversity, if you will, in our shareholder registry because we have a group of investment banks that reached out to a different universe of investors. And by the way, some of our biggest orders came through the diversity inclusion syndicate. One of the largest family offices, in the country, one of the most wealthiest families in the country, came through. One of the firms, one of the largest long-only managers in the world, came through an introduction from one of these firms. So it was just really a win-win, and a credit to all of the banks, Citi, Jefferies as well, and UBS for working alongside the firm. So I think we have a prototype. If I were a public company today of any kind looking to do a transaction, it's just good business to have a broader base of firms and super talented, great relationships,
right,
and a great experience.
And it does seem pretty phenomenal that that kind of precedent has to be set in the year 2020, but indeed it does, and now you have, and perhaps that will be the norm going forward. So, Bill, talk to us about anchor investors or the investing class that you managed to visit with during this pandemic. Can you tell us anything about who has invested or how long they will leave their capital for, what kind of redemption clauses you have, and so on?
So again, this is a public company. Every share trades every day. Everyone has a free option to exit anytime they want, just like any other public company. What we did instead of the typical SPAC is designed in a manner where it attracts a group of investors, very talented, smart investors, but they're not particularly interested in the ultimate target because they get a lot of upfront rewards just for investing in the IPO. And what I'm referring to is typical SPAC. For every share you buy, you get a piece of a warrant, and the warrant becomes saleable or transferable just after the IPO. And a lot of investors buy every, there's a SPAC mafia known for buying every share in an IPO, splitting off the warrants, creating either cheap stock or free warrants. But many of them, that's a different game, if you will, than what we were trying to, and again, I'm not diminishing investors' right to pursue the opportunity for profit. What we did instead is we wanted to recruit a group of partners that would work alongside us. And by work, I mean they could provide introductions, connections, ideas. Their presence on the cap table of the company would actually attract potential counterparties. And we didn't need to bribe them with a big pile of warrants at the time of the IPO. And so our structure, we maintain the same economics of other SPACs. You do get a third of a warrant ultimately for every share you buy, but only if you invest in the target company. And that other benefit of the structure is because the shares will always trade with at least 2/9 of a warrant per share. By the time we identify a target, announce a transaction, the stock should trade up meaningfully. One, because we're going to buy a great company at a very attractive valuation for the minority interest that we're purchasing.
Yes.
Two, because the shares are attached to warrants. And as long as the stock trades above the $20 redemption price, no one redeems. And we eliminate the biggest problem of SPACs, which is they're scrambling to raise capital at the time they do a deal. Here we've raised $5 billion and the money will be there. Raised $4 billion, committing $1 billion. Money will be there at the time we do a transaction. And
potentially up to $3 billion and maybe even more beyond that. Eventually, there's all sorts of extra clauses written into this particular IPO. Bill, we're speaking, by the way, with Bill Ackman of Pershing Square on the occasion of the IPO of a new SPAC, Pershing Square Tontine Holdings, which is now up about 9% in trading. So let's move to the targets, Bill. First of all, do you have time to target? We know already that it's 2 years plus. You can add to that, but I imagine that you are using this time where the pandemic has maybe given you more of a discount on certain assets potentially to do your due diligence now that you can very quickly and get to some kind of target. So time to target, and then what kinds of areas are you targeting? We know that you've given a list of 4 sort of elements that you really want to see and that you're looking at. Can you give us any more details?
Absolutely. So, we think the target universe is probably 150 companies total, $10 billion plus private companies. There are more that we're not including. We're not including in that subsidiaries of large corporations. We're not including some employee-owned businesses in that list. But the list is broader than 150. We think the top third will meet our quality thresholds. We're looking for a simple, predictable, free cash flow generative company with very high barriers to entry, with minimal exposure to what we call risks, extrinsic risk we can't control. We're looking for the super durable, great growth business that we can own for the next decade. That's kind of the target. The list is a list that we have in mind. There may be others we're not aware of. We welcome the phone call. But we're going to comb through that list. Stick with me, Vonnie, if you will, please. We're going to look at every deal over the next, we're going to see every deal over the next 6 months. I mean, this is what's interesting about this transaction is every investment banker around the globe is aware that we've just raised the largest blank check company in the world. We've got $5 billion of capital that we're looking forward to committing to buy a minority common stock interest in a company. It's the only such pool in the world. I refer to it in a way as its own unicorn. And basically, we're in a unicorn mating dance, and we want to, marry a very attractive unicorn on the other side that meets our characteristics. And we've designed ourselves to be a really attractive partner, and that's what we're going to do. And in terms of
Bill?
specific companies, I'd rather not name specific companies. But go ahead.
Some names are already out there, and I don't think they meet all your criteria. So, for example, you say a company that's not exposed to extrinsic risks. Would that take Airbnb out of the equation?
What I mean to say is every business is exposed to extrinsic risks, but if the extrinsic risk is one that is catastrophic, so for example, if you're an energy company and the price of oil goes down to 20 and you're bankrupt, that's not for us. Every bit, we own Hilton today. It's clearly exposed to pandemic risk, but it's a business that survives through a crisis like this, becomes a more dominant business after a crisis like this. We would certainly take a look at a company like Airbnb. I've always admired the business. I've admired its economic characteristics. I know many Airbnb, a friend who makes a large amount of her income by renting out the ground floor of her brownstone, has had amazing experience with the company. Certainly a business we would look at, very attractive economic characteristics. We don't require that a company today is cash flow positive on an overall basis. We just require it has extremely economic, attractive characteristics, and that we can predict with a pretty high degree of confidence how those cash flows will grow over the long term. And that's the kind of business that we're looking at.
Well, so Bill, I'm also curious if you're expanding your universe. So we know, for example, that you've been involved in hospitality and transports and all sorts of those kinds of areas. But technology, for example, would you be interested in learning about it now? It's definitely something Warren Buffett is sorry he didn't do sooner. And some of what you bring up, tends to have Silicon Valley language. And I wonder if you wouldn't be looking at, a Silicon Valley kind of company.
Sure, absolutely, completely open. The issue for us has been there's a number of businesses that we have enormous admiration for, and only brief moments have they gotten to a price that we were excited about transacting. But some of the best, greatest businesses in the world are the Amazons, the Googles of the world, and if we can find a private equivalent, we'd love to own them.
Well, there are some. So there's Palantir, for example, which has obviously been having a little bit of, I don't want to say difficulty, but it's been thinking about how it's going to go public very soon. There's also Elon Musk's SpaceX, and we know that you're interested in Elon Musk's business. You actually invited him to come to Nevada. Did he reply? Have you spoken with him?
I haven't spoken with him. I think he's targeting Austin, Texas at this point. But we've got a spot for him in Nevada. We have a spot for him in Houston. We would certainly, this is the Howard Hughes company that I'm referring to, the board I currently chair. We have a lot of admiration for Elon Musk and what he's accomplished. I think the answer is we have a very open mind about the business that we're going to look at. Private companies, we don't have the financials, we don't know the details, about the economics of the various businesses. But we take a hard look at pretty much every name that you've mentioned. It just has to be a great business with a wonderful management team. But we have to be able to understand the business and predict with a pretty high degree of confidence what the future looks like. We are not speculative investors. We're not going to buy a Waymo, at this point, a zero revenue, pure technology company is not for us. We're looking for a business that has established economic characteristics, predictable long-term cash flows. Those are the kind of key characteristics of what we're looking for.
Right, and it does strike me that the likes of Palantir, as you say, it doesn't have to be profitable yet, right? But as long as there is a vision for that, and maybe the business model needs to be tidied up a little bit, or again something like a SpaceX, which might end up being, a transport company in the end, or a tourism company, both of which you've obviously done a lot of work in. Bill, let me talk to you about the market, because your holdings are sort of the holdings that you've had for a long time for the most part. You cycled in and out of a couple of new ones, including Blackstone, when you made that comment that private equity portfolio companies were going to go to zero, and then sort of, you said that was just for a short period of time.
I never said that private equity companies would go to zero. I said
portfolio, some of them.
What I said was, if we mishandle this crisis, right, i.e. we do nothing and we sit and we let the virus run around the world, we end up in a very dark place. Every business goes bust. And that's why we can't allow that to happen. And we should shut down the country. That was basically my argument. And I've made a pretty bullish case that had we taken a hard shutdown, we would have had a better outcome, both economically and from a virus perspective. But the good news is we're going to get through this. There's going to be a vaccine. I think that's a reasonably high probability event. There are a number of meaningful candidates. We're on the cusp, hopefully. I heard, from a trusted colleague, he's on a board of a company with called a Chinese VIP, who's on the board of one of the state-owned enterprises in China. And he was recently vaccinated along with 40,000 other Chinese VIPs. And if the Chinese government is in fact vaccinating the 40,000 most important or high-profile citizens, they're clearly pretty far along on developing a safe, and effective vaccine. So I think,
Yeah, I was actually going to cite your letter to investors in March, where you said thousands of people have or will soon become severely sick. And, at the end of that quote, you said that we must learn lessons from this. So I was actually going to mention that you called it in many ways. Obviously, that quote, hell is coming, it did come for, 150,000 people in a lot of ways. But Bill, can I ask you just a few questions about the environment now, very, very briefly, with brief answers, because we're almost out of time. Are you thinking about relations with China, and does that concern you?
Of course. Look, I think, a globally connected world is a better world and a more, there's a bigger pie for all to share. And I think, a breakdown in relationships with China is obviously not a good thing. At the same time, I do think I respect the administration's, China has been pretty aggressive on issues of intellectual property, for example. I don't know the specific details of the issues concerning the Houston consulate, but you read in the press about document destruction, burning documents in the courtyard of the consulate. It doesn't look good for China. I have enormous respect for the Chinese. I think they've built an incredible country, economy, but like all of us, they're not perfect. And I think the Trump administration has been, stronger with China than any other previous administration in many years, and I think that strength is, in certain cases, very important to be demonstrated.
Just because you have a history with the Hong Kong peg, I do want to ask you about reports that circulate from time to time that the administration is very concerned about, hammering the Hong Kong peg. Does something like that happen in our lifetimes, Bill?
I really have no idea. I have no idea.
Okay. What about the idea that the economy is not going to come out of recession anytime soon? That we're in, a big, deep hole for a long time. But the market is not really reflecting that. We're seeing records in some cases. Does that continue? What interests you just regularly about the market right now? What are the questions that concern you?
Yeah, so look, I think the economy is going to be a very mixed experience. We had, I would call it, as I say, a sloppy closure of the economy and a sloppy opening. And that leads to, if you will, a sloppy economy. And I think we need some hope and confidence. I think that comes with, improved therapeutics, which is already happening. I think that comes with a vaccine, which I think hopefully is something approaching inevitable in the relative short term. That will give people confidence, and we will get through this. But the period in the middle is going to be a middling experience. Now, it affects different companies differently. The stock market is a reflection of kind of biggest, most dominant, best capitalized, businesses in America. And the ones that are not, the moms and pops, are the ones that are really suffering. And There isn't a publicly traded index of mom and pop companies. If there were, that market will be down 80% today, and that's the tragedy of the crisis. And those are the people that need our collective assistance. So if you sit home and just look at your screen, you say, okay, everything's fine. The answer is everything is not fine for a meaningful percentage of America. That's why we need to support people, and that's why we need to come out of this as soon as possible. And I think everyone, whenever they were in contact with others, would wear a mask, we'd have less sickness, less death, and a better economy. And I'm glad to see the president promoting the wearing of a mask. I think a lot of people follow his lead, and I think hopefully that will help mitigate the recent rise in cases in Florida, California, Texas, etc.
Bill, there was a story yesterday out and about that WeWork has 2 million square feet of 9 million or so, empty, vacant in Manhattan. What would you do with a WeWork right now? If you're obviously bullish hotels, you're bullish property, you're bullish real estate. What would you do with something like that?
So actually, WeWork has a very capable CEO today that I know well, Sandeep Mathrani. And if anyone can turn this thing around, it's him. He's been handed a complicated deck of cards. But I do think that company was run in not a particularly good manner. And I think there's a huge opportunity for improving the efficiency of the business. I do think that in the long term, and maybe even in the intermediate term, the kind of WeWork type space is going to be part of almost every company's. If you think about office space today, the conventional, traditional office where everyone worked in the office, I think we're moving to a world where some people work in the office, a certain number of days a week. Some people work from home a certain number of days a week, and some people work in remote offices and WeWork type locations. Why would you, lease property in 100 countries when you can make a deal with WeWork and land a team? So I think there is a business model there that makes sense. You got to get their cost structure in line. This is a super challenging period. Again, while everyone's sitting at home, they can. The first lease you terminate is your short-term WeWork lease, but I think the business is a real business over the long term. And the question, if they have a sufficient capital to make it through, I do think there's a business model there that can earn attractive returns for investors.
Bill, we've less than a minute left, so I do want to ask you one last question on the Spac. Somebody you've worked with a lot, mostly successfully, is Martin Franklin. He doesn't get involved in bidding wars. Would you?
No, there won't be a bidding war. Here's the interesting thing. What we've created is the only $5 billion blank check company in the world. The next largest is, less than $1 billion. We are not today, if you're a $500 or $1 billion SPAC, you're competing against 20, 30, 40, 50 other SPACs looking to do deals. We are the only such $5 billion entity in the world. We have the lowest cost of capital, the least amount of frictional costs. So, if you're an investment banker at any firm around the globe, what you're doing today is you're picking up the phone, you're calling your favorite $10 billion plus market cap private company and saying, wow, isn't this an interesting way for us to go public? Maybe we should call Bill first. So we welcome the inbound call.